Okay, great. I'll kick it off then. So welcome to another webinar, a tax webinar from Nathan Trust. Today we're going to focus on inheritance tax. Just a bit of housekeeping first. So we record all the webinars and we put them on our YouTube channel. So everybody that has signed up and has registered for it will receive an email with a link to view the webinar at a later stage. Just introducing David Bruton, who heads up our tax and accounting team. He's a chartered tax advisor and he's here to answer all the questions. David, how are you?
Good, Philip.
Great. So before we get into it, I suppose, Dave, do you want to, oh yeah, this Q&A is an important feature of this. So if you have a question, just like Michael put in there that he said he could hear Dave, which is very useful. If you can put in your questions and ask them in the Q&A bit, we'll do our best to answer them. We have a couple of questions that were asked beforehand, and we also have a number of questions that we would have been asked throughout dealing with clients all the time. So we'll get to that, but we really appreciate your questions on the fly and we'll do our best to answer them. So I suppose to start with Dave, the normal question is if you want to just give a kind of a high level outline of what inheritance tax or CAT, what it involves, and what the normal impact of it is from a beneficiary or a disponer's perspective.
Sure. So I suppose maybe to kind of explain some of the terminology, it's CAT, so it's capital acquisitions tax, and what most people would know it as is gift or inheritance tax. So it applies where a gift or an inheritance is made. And, I suppose generally it applies where the gift is made in Ireland, the beneficiaries in Ireland, or the person making the gift is in Ireland. We can get into that in a little bit more detail later on. You have thresholds, so you have these lifetime thresholds under which if the gift is under the value of the threshold, you don't pay tax, and there are different thresholds depending on your relationship with people, but you've one lifetime limit for each threshold. And once you exceed that threshold, then you're paying tax at 33%, and it's the person receiving the benefit who's liable for that tax. So I suppose that's kind of the broad outlines of CAT. And just when we talk about beneficiary, that's obviously the person receiving the gift or inheritance, and the disponer then is the person who's making the gift or leaving the inheritance. We can't hear you there at the moment, Philip.
Have you got me there?
Yeah, you're back.
Yeah, great. A couple of questions there. There's always a couple of interesting ones coming on inheritance tax. I'm inheriting a lot of artwork, paintings mainly. I've no idea the value, although they're possibly quite expensive. How is this priced? How is this dealt with from an inheritance tax perspective? I think that's what they're asking there.
I suppose inheritance tax it's self-assessment, so it's up to you to value the paintings. And I suppose what you don't want to do is you don't want to value them at a completely different value than, say, revenue might take a view that they're worth. I suppose how would you value it if you went and got a valuation from a reputable art dealer or an expert in that area, and you had a written valuation of those paintings? I think revenue would be inclined to accept that. Now, I suppose, no more than other asset classes, a valuation can differ from one person to another, but that would be a good starting point.
Reputable art dealer, do you have a list?
I don't, I know.
But is that where some of the challenges could come in, that you get a price? So if you inherited for, say, an art collection for, say, 100,000 euros tomorrow, and then 5 years later you sell them for 500,000 euros, obviously you've got a cap, you're paying tax on that anyway. Do you find yourself in trouble then?
No, not necessarily. I suppose, art in particular, more so than any other asset class, I suppose the valuation is very subjective because no two artworks are exactly the same. So, the valuation put on an artwork by a particular artist could differ significantly over a period of time. So the fact that it's selling for, 5 times what you valued it at a couple of years beforehand, you may be able to justify that if you look at other sales by the same artist or similar artists that would be relevant. So not necessarily, I suppose the risk comes in that you could bring that same painting to 2 different art dealers, and they may differ at significantly different values potentially. If it was a concern, I suppose you could kind of get 2-3 valuations and take the average. But I think if you're in a situation like that, if you're relying on an expert opinion, to some extent you're doing as much as you can in terms of arriving at the valuation.
And revenue are going to get their piece of flesh anyway, so they're not going to beat you up whether they got it 1 year or 4 years down the road too much, are they?
I would imagine revenue would only look to challenge it if they thought for some reason that you're after significantly undervaluing the asset. Other than that, I think particularly with artwork, I think they'd be, if you can show that at the time you went and you got a valuation that's reasonable, I don't think they'd be looking to argue with it unless for some reason they thought you would significantly undervalued it.
And that would be similar for jewelry and watches, because quite often there could be quite a lot of value tied up in that, but it's, how much does it cost, or people aren't going to sell them straight away, etc.
Yeah, and I suppose in some cases they may never sell them because it may be something with sentimental value or a family heirloom. So yeah, again, I suppose if it's not readily apparent what the valuation is, I would suggest you get it valued by a jeweler or an antique expert, something like that.
Okay, we've one here. I'm an Irish citizen living in the UK, and if I inherit in Ireland, do I pay UK or Irish inheritance tax on it, or both?
It's potentially both. So it's dependent on where the asset is situated. So what would typically happen there is, let's say if the asset is situated in Ireland, there would be Irish inheritance tax to pay on that, or gift tax. And then what would happen is that the UK would probably have a taxing right based on the fact that you're living there. But as the country in which you're a resident, it would be the UK that would give a credit for the Irish tax suffered. So you're taxable on it in both countries, but you won't be taxed fully in both countries. The country where you're resident, the UK, will allow a credit for the Irish tax.
Okay. As a main shareholder in the transfer of shares in the company made under one's will, or does one need to make the transfer before death?
You don't need to make the transfer before death. There can be certain circumstances where you might want to do it, but I suppose what you'd want to be aware of is that if you transfer before death, you have to consider CGT. It's not necessarily the case that you'd have a CGT liability, but you've got to consider it. There's no CGT on debt. The other thing that would come into play as well is stamp duty. There's no stamp duty where shares are transferred under a will. Otherwise, there would be. So you're potentially looking at 2 additional tax heads there if you transfer before someone passes away. If you leave it under your will, the beneficiaries, they're potentially entitled to the same reliefs. There's a thing called business relief, which can be very valuable. And they're not going to be taxed massively differently, whether it's when you're alive or whether you pass away. So I'd say, there could be specific reasons why you might want to do it now, but I would just be aware that you could be bringing other taxes into play. Okay,
so what you're saying is that if you've got a company, you sell the share, you transfer the shares before you die to try, and you personally would have, if there's a capital gain, if the value of the company is increased, you'd have a tax activity then, and then there would also be a tax activity for the beneficiary.
Exactly. Yeah. Now, with you'd be exposed to CGT, or there'd be a CGT event, let me put it that way. But it doesn't mean that the person would have a CGT liability. There's a thing called retirement relief, which can mean that a lot of businesses, when a person either passes it on to the next generation or sells it, that they don't necessarily have a capital gains tax liability. So there isn't absolutely a CGT liability, but you have to consider it. There can be reasons why you'd pass on now. I mean, for example, depending on the valuation of the company, if you knew that the valuation was going to increase significantly over a number of years and the inheritance tax liability was going to increase with that, you might consider doing it now. The other thing that's relevant is you can generally offset any CGT liability against the CAT liability as well on the same event, where you're transferring like that. So it would depend on the circumstances, I suppose.
Okay, we've crypto one here. We love we always love a crypto one. Our NFTs are similar digital assets, evaluated similarly as, let's say, a painting when it comes to paying taxes.
Yes, I suppose in terms of the valuation, you know, it's I suppose it's probably, again, you're into that area where the asset value is subjective. So I would think if you don't have a valuation that you can readily point to in terms of, you know, if you'd recently acquired it, the value you acquired it at might be a good indicator of its current value. If you don't have that kind of a value you can fall back on, then yes, I suppose you're maybe, I don't know if there's experts out there who value NFTs, to be honest with you, but if there are, that's what you would be looking to maybe rely on an opinion from someone like that.
So, but essentially it's an asset like any other asset, really, isn't it?
It is, yeah. For tax purposes, it is an asset, yeah.
Okay. May I know if such a person moves to Ireland in 2020 for the first time, they would be treated as a resident for the purposes of CAT in 2025. That person returned back to the original domicile country in 2024 to finish job. After 1 year of resident, non-resident get a job in Ireland, they still need to pay CGT, or is there an exemption? It's kind of a long question. Yeah,
I think I know what they're getting at. That where you've someone who's not.
I hope you do, because I don't want to have to read out the entire question. So actually, thank you. I asked for questions and I always end up slagging them. I apologize for that. Thank you for the question.
So I suppose where you've got someone who's not domiciled in Ireland, for the purposes of CAT, they're only considered tax resident here after they've been resident here for 5 consecutive years. So start of year 6. So the person there is referring to that individual breaking their 5 or not making the 5 consecutive years. So they wouldn't be considered tax resident for the purposes of CAT. And then they've mentioned capital gains tax. So for capital gains tax, you don't have that 5-year consecutive residency requirement. So for capital gains tax purposes, a person is resident for CGT if they're resident here in the year, or if they're ordinarily resident. They can potentially be within the Irish CGT net. So ordinarily resident, I know we're going to get into a lot of different residency terms here, but ordinarily resident means that they've been resident here for 3 consecutive years. So you then hold that until you've been non-resident for 3 consecutive years. So in the scenario that they're mentioning, where the person's been here for maybe 4 years, gone away for a year, come back, they're likely ordinarily resident in Ireland for CGT purposes. So they would be within the capital gains tax net. But if they're not domiciled, they're not if they don't bring the funds back into Ireland, if it's a non-Irish asset that they're disposing of.
Yeah, I think I think that alludes to, some of them are more complicated, and this is like some of the work we do with regards to tax planning is teasing out these type of scenarios, documenting the findings, and then enabling people to make good decisions, tax efficient decisions, but also get compliant and help them sleep at night, because there is inherent complexity here, isn't there?
There is, absolutely, yeah, particularly when you're looking at cross-border. Okay,
the follow-up to that, so no need for CAT because you break the 5-year rule, question mark. I don't know, is that follow-up to that, or do you?
So it depends on, so that individual who's not completed their 5 consecutive years, they're not considered Irish resident for CAT purposes. But if the asset is located in Ireland, or if the beneficiary is in Ireland, or the disponer is in Ireland and resident, either of those 2 individuals are resident here, you could be within the Irish CAT net. So for example, that individual, if the gift or inheritance is an Irish asset, you're looking at Irish CAT. Or depending on whether that individual is the beneficiary or the disponer, if the other party is Irish resident, you're potentially looking at Irish CAT on that gift or inheritance as well. That's again one of the more kind of the slight complications there as well. And
we're here to ask questions rather than sell services as much, but we do offer a service where we can do an hour's consultation with people. That's €295, including VAT. And we can tease out these things, and sometimes we can solve the problem in an hour and people can go away and make the decisions themselves and give them clear guidance. Sometimes it takes a bit more work on top of that, but this is the kind of work we tend to be doing with a lot of individuals to help make sense of this complicated tax stuff. There's one here. I'm living with my parent. I'm living in my parents' house, but I've moved in with them. And my parents are living with me, do I still have to pay CAT on the house if I've been living in it for a number of years?
So there's a thing called dwelling house exemption that was quite widely used a couple of years ago. So basically, people would go out and they'd buy a house, and their son or daughter would live in the house, and after a certain period of time, they'd gift them the house, and it was exempt from CAT. It fell outside of the CAT net, so you didn't need to consider your thresholds. That's still there, but it's been restricted quite a lot. So the person the parents would need to be living in the house. The person who's the beneficiary would also need to be living in the house and would need to have lived in the house. I think from memory, it's 3 years that they need to have lived in the house as their main residence. They can't have an interest in another house, so they couldn't own part of another house or own another house completely, or apartment or anything like that. And then they've tightened up the rules in it in terms of the parent being a dependent relative effectively. So depending on the circumstances and getting into the detail on it, it's possible that no CAT would be due on that gift or inheritance.
Okay, so there is an opportunity there, but again, God is in the detail there. You need to get your planning done on that and make sure you're doing all the right things, because I'd say that is something that revenue would challenge, wouldn't they?
I suppose it's one of the more obvious ones, because with transfer of property, you've got property records, so it's very easy for revenue to see a transfer of a house or land or something like that. So I suppose I would expect that generally it would there would be a cross check there to see if if a return had been made.
Okay, there's another one here. I'm 72 and my beneficiaries are likely to face a substantial CAT inheritance tax bill. Is there anything I can do to reduce this?
There are a number of things, I suppose, depending on the person's preferences. So I suppose, one of the overlooked ones is the small gift exemption. What that allows you to do is to pay €3,000 a year to an individual without that being liable to gift or inheritance tax, but also without it eating into their lifetime thresholds. So if you take someone, if they've got, kids, and those kids have kids, take an example of someone with 2 kids, and each of those people have 2 kids and are married, you're suddenly looking at, 4 and 4, 8 people that they can give the small gift to each year, for example. So it can add up over a period of time. It seems very small, but it can add up over a period of time, particularly if you know that, let's say, the beneficiaries are going to use it to fund education for their kids or something like that. So I'd say certainly that's worth considering. That's that's an easy one to do. It doesn't require a lot of planning or anything like that. There are other things, so you can look to see what assets you have, whether there are any exemptions there. Most people don't, but you can change the nature of the asset. So for example, if what you do see some people doing is they'll go out and they'll buy agricultural land, because agricultural land can attract a very significant CAT relief. What it does is it takes the value of subject to meeting certain conditions, you take the value of the land, and for tax purposes, you multiply it by 10% of the market value, and that's the taxable value. So if you took, tract of farmland that's worth 2 million, for tax purposes, it might be worth 200,000 for a gift or inheritance tax. There are conditions to meet. The big one is that the person receiving the farmland, 80%, at the point they receive the farmland, 80% of their assets must be agricultural assets. Now that's generally achievable where they're maybe married and they can transfer certain assets for a period of time. But that's the big test to meet, and but that's, you know, on a point, at a point in time, on a day, they have to meet that test. They don't have to meet it for a period of time. There are other conditions, but they're generally manageable.
Okay, very good. We're coming up, we normally run these for about 25 minutes, so we're coming up to about 2 minutes. So if you've got a quick question, get it in now. But I think on the last one, effectively what you're looking to do, if the person who has that wealth, they want to be able to figure out that they can spend X, they can give away as much of the cash as they can, and they still have enough money to either go to, go to a home, or they still won't run out of money at the end. But all they'll do over maybe the next 10 or 15 years is reduce the amount of tax that their beneficiaries are going to pay. This is the kind of plan people can put in place, and it's not, you don't need to be super brave to do it, or it's not a high risk. But once you get ahead of it, you can substantially reduce the tax liability, can't you?
You can. I mean, what I'd always say to people is that CAT is one of the taxes that you can do the most planning for, and it's not planning in the sense of sailing close to the wind or anything like that. It's just planning in advance. We see two scenarios. One is where someone will come to us and they'll say, I've got a substantial amount of assets that I want to pass on. How do I do it? You can look at their assets, their schedule of assets, and see what you can do with that. The other scenario we see is when someone comes to us and says, I'm after inheriting, certain assets. What can I do? And at that point, generally, you're quite restricted in what you can do. You're not, you have a lot more scope to plan if a person does it well in advance. You can do an awful lot to mitigate the CAT liability.
Okay, all right. There's a couple of questions that we won't get time to. What I'll do is I'll reach out to those individuals, those people individually, just on email later today. So with that, we'll wrap it. Listen, thanks very much for everybody's attendance. Thanks again for your time, Dave. As you know, we're always here to help with these matters. If you do, as I said, they're complicated. If you do need to reach out to us, we're happy to do consultations and do planning on this work. We're doing a lot of at the moment. So we're here to help. And thanks again, Dave. And thanks for everybody for attending.
Thanks.